What a Monday. We knew this day was coming, but your heart still kind of skips a beat when everything starts flashing red. It's now very clear that the business cycle is drawing to a close. Will it pass? Yes. Is it going to hurt a little bit? Yes, most definitely. But this is this week's market review brought to you by ETM Analytics with Treasury One as well. I'm joined by Treasury One's currency strategist, Andre Cillier. So, Andre, obviously, most notably this morning is the Nikkei index dropping like a cannonball, dropped by more than 10%. It is record sell-offs happening. And it's as the yen carry trades are starting to unwind. And this obviously all comes as markets are reacting to the changing economic landscape.
Yes, let's go back a little bit to last week. 3 calls made. We spoke all about monetary policy committee meetings. We made 3 calls. We said yen interest rates will increase. We said the UK will lower these. And we said the Federal Reserve won't do anything, but they will give us an indication, and it's likely that we would hear that the possibility lies ahead of us into September. 3 calls made, 3 correct calls. What are we discussing today? The impact. Now, if we look at the yen interest rate, and you look at the move that was made on interest rates there, it might seem small, but in terms of where their interest rates was and for how long it's been there, it's been a massive move. We know that the yen was dramatically in a weak spot. It was trading above the 160s against the dollar. And we've seen a massive retreat back down to 142, 143. Once again, a very big move. But the biggest move at the back of that is the stock exchange trades. That is also dramatic, as you say. Between 10 and 12% down. That's, if you were invested there, a nasty hit to your bottom line. But why? Well, the carry trade is, if some people don't really understand it, it's simply where you go and borrow money in the Japanese yen, where interest rates are extremely low, and you go and invest your money elsewhere in the world, where you get better yields. Now, with a gap between interest rates, and this graph clearly shows us how quickly this gap is beginning to narrow between what Japanese rates are and what US rates are. And with the speculation and market expectations in the US that interest rates, 2 banks there now forecasting that we could see 2 drops this year of 50 basis points each. That means this gap could narrow quite a bit more. And that means that the carry trade is becoming less and less attractive. And people are starting to unwind those carry trades. That's billions of dollars, literally billions of dollars, which means that there's huge trades going through the market, huge movement of funds between countries taking place. And hence these very, very big moves. But at the same time, the Japanese economy is still not doing well. And the impact of these interest rates and so forth could have a dramatic impact on the bottom line of companies and the results to be presented by them, and hence this massive move in the stock exchange as well. So interesting times. And I don't think it's about to stop very, very quickly.
It is also worth mentioning that the Japanese central bank were very hawkish in their stance while you had the Fed becoming softer. So it was really this perfect storm being created for the situation that we play out. So you had the situation with the yen, but really what just was the spark on the Kindle was the July job employment report that was a lot weaker than expected. We saw US Treasury yields drop dramatically also on the back of the report. And now, like you mentioned, markets all of a sudden went from 25 basis point cut in September just a couple of days ago to now expecting 50 or even more in the next coming months of rate cuts coming from the Fed. And I'm curious, this big jump that we saw going from 25 basis to 50 basis points and a lot more being priced in for the months ahead coming from the Fed. Is this perhaps a flag from the markets to show that they think that the Fed took too long before they decided to move? It was just one decision too late, because if we're looking what's happening on the stock market and everywhere else, maybe they should have moved sooner. I don't know.
I think the markets is a little bit in that space where they think the decision to cut is one step too far. And what makes it crucial at this point in time is the fact that we are there where we're skipping the month of August for an MPC meeting, and it now goes straight over to September. And with the figures coming out the way they are coming out, I think the market tells us that they fear that the next round of releasing of figures could be even worse. And that could then prove, as you rightly mentioned, that it was one step too late and that they've taken too long. And I think that this whole trigger point came after Friday. I think if the figures on Friday didn't come out so much below what the expectation was in terms of non-farm payrolls, this move could have been dragged out for a little bit longer to happen. But with the release of the non-farm payrolls on Friday, a lot worse than what was expected, and also the rise in the unemployment rate to 4.3%. Led to the fall in the US Treasury yields, and we can clearly see that on the graph, how sharply that turned. And that, going back to our first graph of the differential between countries narrowing significantly, triggered this move early in the morning in the Far East and gave us these big, massive moves. Now, moves that we are seeing also in Europe today. We're also seeing it in our own stock exchange. Everybody doing really, really badly. It's red all over. And as I said, this could now go on a little bit longer. We might not be right at the end of what we expect here.
No, I think it's still going to hurt for a little while longer. But the Rand, what does this mean for the Rand? Because you have this risk on sentiment due to a possible new warning of a war happening in the Middle East, with Iran wanting to retaliate on the attack in Lebanon. We have, all these jitters around market happening. So there's panic selling going on. You have the yen carry trade. Where's the Rand floating in the sea that we're going to go into?
Well, 1850, we must think over the last 3 weeks, 1850 proved to be a sticky point where it didn't want to go through, and we quite a bit through it now. We're at 1858 as we stand right now. And with everything happening in the world, we must always remember that we are still just one of those little emerging markets that forms part of that space. And when money starts flowing through the world, then it's because of trigger points, and we've now discussed that. But that immediately puts people a little bit on the back foot as to say, safe haven, very liquid markets, or shall I stick around with the emerging market space? Now, we've had a very good run on our bond market since May, when the elections took place. A very good run. We've had massive inflows into our bond market. And with carry trade unwinding, I'm not too surprised to see the Rand a little bit higher this morning, where people sort of unwind positions in terms of carry trade. It might be that we could also possibly over the next couple of days see a bit of an outflow out of our bond market. Our stock exchange is also doing badly in conjunction with the rest of the world. So that's all. A lot of that flows is foreign. and a lot of those trades are foreign trades. The stock exchange benefited from inflows, and it now has the disadvantage of the outflows. So the rand, I'm not too surprised that it's breaching the 1850 level. I don't think that that's a permanent one. I don't think it's a long-lasting one. If I look at the euro, 109.50 currently. It's been a little bit higher already today. If the Federal Reserve comes back after their nice long holiday in August, and in September we do get these cuts, then I think that the euro will be on a continued stronger path. So will be the pound and other first world currencies. And emerging market currencies will then also benefit from that, because that could have an impact on economic growth throughout the world and a positive sentiment going through the world. And then the rand could benefit from that again, and we could see a 110 and a 112 on the euro, with the rand coming back down to the 18 levels. So I don't think that we're permanently breaking out of trading ranges here. I think there's opportunities being created for exporters at this point in time, and I think they should actually start looking at taking some of these opportunities. They especially presenting themselves in terms of the cross rates. Euro back up at 2036 levels that we haven't seen for quite a bit. Pound getting closer, 23.75. So opportunities is always arising. These moves always create opportunities, threats for some people, opportunities for others. So if you're an exporter, this morning and the next couple of days might be your turn to get some opportunity of getting some of your hedges done.
Well, if a week is a long time in politics, then a couple of days is a decade for the financial markets. So let's see how this plays out. If it's going to get worse, if it somehow will pull back slightly. It's definitely an interesting week ahead for us. But Andre, we will catch up again then on Monday.
Well, nobody ever said that it's going to be easy. Enjoy your week.